Rates are up tremendously and literally double from what they were last year this time. That disincentivizes the buyers from buying a home, right? Obviously, if the rates are up more than double from last year and the housing has also gone up in value, doesn't that obviously mean that inventory is going to be a lot? We're going to have a lot of houses sitting and nobody wants to buy? If that's what you thought at the beginning of the year and that's what you're thinking now, you're totally wrong. In fact, our inventory is extremely low. And it's not just in Silicon Valley, it's actually nationwide. Stick around, I'll let you know what inventory currently is and why it might be there. But really what you want to look at now is, why is the inventory so low and why are people not freaking out about higher interest rates? Here in Silicon Valley, one of the main things that always drives our market is the stock market. When the stock market has any kind of a hiccup, any kind of a scare, then people stop buying. The stock market is even doing okay. People continue to buy. And in Silicon Valley, that just tends to be the way that it goes. The big story is, when will inventory become normal again? And what is normal inventory? We tend to not really have normal inventory in Silicon Valley. We do tend to have inventory that's maybe 3 months. And inventory, a month of inventory is how long does it take for, if the houses on the market were to stop producing and the buyers were to stop coming, how long would it take to eat those houses up? 3 months typically is a very high amount for us. Nationwide, 5 to 5.5 months is actually what people can expect. Here, we tend to be much, much tighter than that 5.5 months. Like I said, 3 months is actually a lot. Interest rates are up. The Feds decided to pause interest rates in June, but they did say they're planning to hike at least twice more this year. What's happening is the Feds, the Federal Reserve, are raising the interest rates to cool the economy. Cooling the economy helps all the inflation to kind of tame down so things aren't so expensive. And as the interest rates go up, things do get more expensive because interest rates are up. That means that everything else, anything that you purchase on a credit card or anything that you purchase anywhere else, inflation is going to be up, credit card rates are going to be up. And now once that starts to tape back the other way and the inflation starts to go down, then they'll start to drop the interest rates as well. Well, what does that mean? That means that right now we're at the top of what the Feds will be raising the rates to. Maybe twice more. Don't know exactly what they're going to do with that. But when the Feds raise the rates, that means that they have always historically over-tightened. So people who are savvy buyers at this point in time are looking to purchase what they can, because as soon as the interest rates come back down, that means that they'll be able to refinance into a lower monthly payment, and the equity in their home is going to grow even more because more buyers are going to get in because they've been waiting for a long time. So that's what the savvy buyers are doing right now. They're purchasing the homes that they can afford on the interest rate that they can currently afford. Purchasing with those interest rates allows them to then get into a home so they can eventually refinance for a lower rate. Nobody knows exactly what those rates are going to look like when they do get there. It is projected that over the next 3 years, we'll probably have strong rates again as far as low interest rates again within the next 3 years. But again, there's really no crystal ball that's going to tell us exactly what that's going to look like. And we have had historic interest rate lows. So to say that we're going to get back to 3%, 2.5% even, that's really stretching it and very unlikely. But to go from the 7% that we have now to maybe 3.5% to 4%, it's more likely, and I don't know exactly where things are going to go. Now, one thing that I think many people are doing right now, and this seems to be the case for a lot of folks, did you know that 79% of baby boomers own their home? And did you know from 2020 to 2022, the average home appreciated more than 50%? That is a huge event. That means that if you had a home that was worth $800,000, in less than 3 years, that home would then be worth $1,200,000. If you had a home that was worth $1 million, in less than 3 years, that home would then be worth $1,500,000. If you had a home that was worth $1.5 million in less than 3 years, that home would be worth $2.25 million. If you had a home that was worth $2.25 million in less than 3 years, that home would be worth $3,375,000. And if you had a home that was worth $3,375,000 in less than 3 years, that home would be worth $5,062,500. My point here is this. We had an historic run up our housing prices. The people who owned the homes at the time are now in a very strong position. Let's say that you happen to be a baby boomer or someone who is of an older age than a baby boomer. You have an historic time to be able to sell the home that you're in and then buy a home lower. Buy a home that's a smaller home and pay cash for that home. Now, Silicon Valley, it's not uncommon for people to sell their home here and then purchase cash someplace else. Silicon Valley tends to be a more expensive area. So that's overall an opportunity that many people have that they typically wouldn't have, is to sell that home with that extra 50% of equity that they gained in less than 3 years, and then purchase a home that's a smaller home and downsize. For whatever reason, they may choose to. And people always have different reasons to do this. Year to date, single-family home prices have increased 20% in San Mateo County and 24% in Santa Clara County. They've increased by 3% in Santa Cruz County. Condo prices in San Mateo and Santa Clara were up by 12% and 19%. Respectively in the first half of 2023, while Santa Cruz condo prices were down by 7%. Single-family home prices were up in the first half of 2023 across Silicon Valley, with significant gains in San Mateo and Santa Clara counties, up 20 and 24% respectively. Single-family home sales rose while new listings fell from May to June, causing inventory to fall for the first time this year. Condo inventory grew further as sales slowed slightly and new listings increased. Total inventory remains depressed, but has experienced some growth this year, which has helped to elevate some excess demand. Months of supply inventory has declined significantly in 2023. Homes are selling more quickly and sellers are receiving greater percentage of asking price, all of which highlight increasingly competitive environment for buyers. What's interesting, in January of 2023, the average seller received 94% of the asking price, meaning that in January of 2023, we were in a position where people were not purchasing as homes as fast as they were at one point. 94% is 6% less than asking price, right? Sorry, it's a spoiler alert. But 6% less than asking price, typically for Silicon Valley, is not the typical norm. So as of now, in June, we're actually back up to 101% of asking price. So there's always going to be different strategies involved in asking price and in sales prices when you price a home. Talk to your agent about that, but typically I'll have a set of rules of engagement for my clients to take a look at, and it also really depends on the market as well. That's one of the things that come into play. So that's something that we work on, and we'll normally price the home just a couple of weeks before we actually go on the market, and sometimes up to the day before we go on the market. Have a conversation with the seller. What makes the most sense? This is what's going on. This is how the market looks. This is where we should go. And it's up to the seller ultimately what price we go to. So there's not really a hard say on 94% being the overall. The very interesting piece to me, and many people I think don't realize this, is that inventory is way down. If you looked at inventory in January of 2023, inventory was actually up. And inventory in January of 2023 was, for a condo, was close to 3 months. And for a single family was close to 2.5 months. Still, that's kind of high for Silicon Valley. It's on the higher side for Silicon Valley, but still fairly low across the board nationwide. So currently, for the single family home, we're just at 1 month worth of inventory. And for the condo, we're just about 1.25 months of inventory. So inventory is extremely low. The prices continue to climb, and the market is strong for a seller to get into the market to sell. The market for a buyer, anybody who's a serious buyer, there is not ever really a bad time to buy in Silicon Valley. If you have the ability to purchase, it's always a good idea in Silicon Valley. The market might take a hit here and there, but ultimately you're going to see your returns. And of course, history will not dictate the future, but this history has been around for a while and continued. And so let's see how things go. But ultimately, investment in your home is not a bad idea in Silicon Valley. If you're looking to purchase a home in Silicon Valley, it is not a bad idea if you want to look at that as a long-term investment as well. I've said it before, if you're looking to flip properties in Silicon Valley, it's a totally different game. It can be very financially risky and overall can scathe you if you're not careful. Let me know if you have any questions. I'm always here and happy to help. I hope you're doing well. Take care.